All right, let's talk about MercadoLibre because this was one of the wildest earnings reports of the season. You had a company that was, by all accounts, absolutely crushing it, just posting monster growth. But then the market just took the stock to the woodshed. So what on earth is going on here?
So here's how we're going to break this down. We'll look at the headline numbers from the quarter, then dig a little deeper into the business itself. After that, we'll get into management strategy, how the market is seeing things differently, and then we'll wrap up with our take on what comes next.
You know, the whole story of this quarter really comes down to a major contradiction. It starts with two key numbers that just don't seem to belong in the same sentence. First, just look at this top-line number. I mean, wow. Revenue grew almost 45% year over year. That didn't just beat expectations, it completely blew them out of the water. Just an absolutely massive number. And then there's this. The day after that incredible revenue number, the market's reaction was to send the stock down more than 10%. So what gives? How do you get from that explosive growth to this painful drop? Well, here's the rub. This table really gets to the heart of it. That incredible revenue beat, we're talking nearly $300 million above what analysts were looking for, it just wasn't enough. It couldn't cover for the miss on the bottom line. Earnings per share came in short, and in this market, that's what investors grabbed onto. Okay, so let's peel back a layer. Because if you look past that EPS number and get into the guts of the business, the momentum is just staggering. It's truly immense. So take the e-commerce business, gross merchandise volume, or GMV. That's basically everything sold on their platform. It shot up 37% to almost $20 billion for one quarter. That is just incredible scale. And if you thought that was impressive, their fintech arm, Mercado Pago, was on another level. Total payment volume, so all the money flowing through their system, jumped 42% to over $83 billion. The fintech engine is just humming. But honestly, the real jaw-dropper was credit. Their loan book nearly doubled in 1 year. It soared 90% to $12.5 billion. That's just hypergrowth. And this growth wasn't isolated. It was everywhere. Fintech users, up. Assets in their investment accounts, way up. Their ads business is on fire. The whole ecosystem is clicking. But here's the kicker. Even with all that crazy growth in lending, their credit quality actually got better. Non-performing loans hit a record low. That's just phenomenal execution. Okay, so if the business is firing on all cylinders, we go back to that original question. Why the disconnect? Well, management had a very, very clear answer on their earnings call. They're playing the long game, and that means they're spending, and spending big. This quote from them really says it all. They basically see this incredible momentum as a golden opportunity, and they are making a very deliberate choice to sacrifice some profit today to pour money back into the business and build what they call moats, those deep, sustainable, competitive advantages. And look, this isn't just random spending. It's incredibly focused. They're spending on making shipping cheaper for you, which makes you buy more. They're building out a massive logistics network. They're pushing hard into credit cards, and they're weaving AI into everything. It's all about locking in their dominance for the next decade. But Wall Street? Well, Wall Street has a very different way of looking at the world. The market is telling a story that's focused entirely on the here and now and the immediate cost of all that investment. And this really captures the two sides of the coin perfectly. You've got management painting this beautiful picture of long-term dominance. But on the other side, you have investors who are looking at their spreadsheets today and seeing rising costs, shrinking margins, and a payoff that feels, well, uncertain. And look, this isn't just a story. It's right there in the numbers, in black and white. Their operating margin took a big hit. It fell from 13.5% a year ago all the way down to about 10%. That is a serious squeeze on profitability, and you can bet the market noticed. And this chart, wow, this right here is the picture of investor frustration. Over the last year, MercadoLibre stock hasn't just lagged the NASDAQ. It has gotten absolutely smoked by the broader Latin American market it's supposed to be a leader in. Investors are just looking at this and thinking, my patience is running out. So, with all that said, where do we go from here? As we head into 2026, what are we going to be watching for on that next earnings call? Okay, here's our take at Talk Tickers. We think this tug-of-war is going to continue for a little while. The revenue growth, yeah, that's going to stay strong. But those margins are going to stay tight as they keep investing. So, we see the stock probably staying stuck in a range, caught between that amazing growth story and the profitability concerns. Because of that, we're giving it a market perform rating. We need to see signs that margins have found a floor before we can get more constructive.
Now, for our final thought, this dynamic, this tension between massive growth and margin fears, it feels like something's got to give, right? And that sets up a potentially interesting way to think about this situation from a trading perspective.
So, the idea here is what's known as an option strangle. It's a pure volatility play. You're not betting on who's right, management or the market. You're betting that this tension can't last forever. The thinking is that once the market finally makes up its mind and decides if all this spending is genius or a huge mistake, the stock is going to make a big move. And a strangle is designed to profit from that big move, no matter which direction it goes.
And of course, we have to end with our final and most important reminder. This is just an idea, a framework to think about the stock. It is absolutely not financial advice. Please do your own research.